Kevin with ALCOVA Mortgage. He's been instructing here for a couple of years. We really appreciate his expertise and knowledge on the subject of credits and mortgages and finance. So Kevin, I'm going to go ahead and turn it over to you. Thank you.
Thanks, Rita. I want to say welcome, everybody. Thanks for attending. This is a great class. I enjoy teaching this one, and it is always our best attended. You mentioned credit. People immediately have interest, especially right now. During the pandemic, everything is upside down and backwards in our world. So today, we're going to go through and cover a lot of the basics of credit reports, credit scoring, what's old, what's new, and what's good to know as an agent, as a realtor. And you know what? Not all loan officers are going to take the time to truly help the clients and buyers that need help. There's a lot of folks out there that maybe don't have credit or just have a few issues that could be fixed up, cleaned up, and ready to go. But if they contact some big internet lender, big bank, and even some local loan officers, they're not going to get the attention that they need to get fixed up, cleaned up, and ready to go. And that's important. You know, it's important, number one, because, hey, we're all commission salespeople, and the more people that we can put into houses, that's our job. But really, it's our mission. Our mission as realtors and as mortgage people are to help provide housing. And sometimes people who are less than perfect or need a little bit of help can be some of your best clients, some of your lifelong clients, and folks that send you the most referrals of other people because you are different. You truly helped them. So today we have a lot to cover, and I know everybody's busy. So some of the basic stuff I'll go through pretty quickly. The stuff that I know often has a lot of questions, I'll dig into in a little bit more detail. And as we go through, as Rita said, there's a pressing question you just can't wait for, that's fine. Raise your hand or send a message. Rita can pop in. And we will definitely have plenty of time for Q&A at the end as we wrap up. So getting started, let's start with a really basic question. What is a credit score? So really, your credit score is just your numerical credit rating. Back in school, we all got letter grades, A, B, C, D, F. Your credit score is your numerical grade. Your credit score range, depending upon the credit bureau model, is about a 300 to an 850. I don't think we ever see a truly perfect 850. And I can't say I've ever seen anybody in the 300s. I've definitely seen 400s, but not 300s. But it's a representation of the credit worthiness of that person, and it's based on information contained in the credit report. Now, your credit score is really kind of what we call often a FICO score. FICO is a software company that started the credit scoring models, the measure of consumer risk. And there's actually 52 different versions of FICO credit scores between the 3 credit bureaus and multiple industries. There can be a huge difference in the scores using the different algorithms. An example, just for me personally, a couple months ago, I got notifications, emails on the same day from different, credit companies, like where we all have like our credit cards and such that say, hey, we'll give you your free credit score. So I got notifications the same day of here's your credit score, and there was a 100-point difference on the same day between 2 notifications. So there can be a really big difference depending upon which credit bureau and which model they're using. So really, what does a credit score truly mean? Your credit score predicts the statistical chance of a consumer becoming late, generally 90 days or more past due, on a particular loan obligation over a 24-month period. So it's the likelihood of them paying on time, or more so the likelihood of them not paying on time, analyzing tons of data, millions of people throughout the United States. They analyze all their credit. They look at the credit habits and the credit profiles of people that pay well and people that don't pay well, and they create the credit scoring model based on that. So when you get your credit score, when I pull my credit score today, that score is generated by analyzing the information contained in that credit report at exactly that point in time today. If I pull my credit report again tomorrow, it could be different because maybe something got updated. Maybe a balance change, one of my trade lines updated. It could be anything, but it changes at that exact moment versus a future moment. Your credit score, your true FICO score, is only available from the 3 credit bureaus. We'll talk about who they are. If it's from anybody else, it's just their own credit scoring model, and those are great. You can still use them as an indicator of how your credit score is doing, but the true credit scores that are used in decision making are only available from the 3 credit bureaus. And to have a credit score, one needs to basically just have an account that's at least 6 months old with updates within the last 6 months, and that account can't be under dispute. So if you have an account that's 2 months old and that's the only thing you have, you probably don't have a credit score yet. If you haven't used credit in any way, shape, or form in the last 2 years, your credit score may be gone. It may have erased because there hasn't been any updates or information to keep your credit score current. All right, let's talk about the credit reporting agencies, the credit bureaus. So there's 3 of them: TransUnion, Equifax, and Experian. There technically is a 4th called Innovis, but it's not really used. It's definitely not used in our world, so we're not going to talk about that one today. And all of them are the credit reporting agencies. There's a little bit of a summary of information on each one of them. It doesn't really necessarily impact us. It used to be that different credit bureaus were more prevalent in different areas of the country, but now they're all basically nationwide. The credit bureaus themselves are known as credit reporting agencies. They're independent from one another. They have nothing to do with each other. In fact, they are competitors. So, they're out trying to get business. Now, in the mortgage world, we use all 3. So when we pull credit, we're going to look at Equifax, Experian, and TransUnion, and we do what we call a merged credit report. It's one report that merges all 3 of them together. But let's say you are applying for an auto loan or a credit card, they're likely only going to use one. So Experian wants you to use them because you pay every time you pull credit. In fact, the credit bureaus make money all over the place. So the credit bureaus make money from when you apply for credit, and we as a mortgage company or the car loan or the bank or whatever pulls credit, they pay for that credit report. Then as soon as you make that inquiry, that credit bureau is going to sell that information. So if you inquire to purchase a car, immediately the credit bureau is going to sell what they call trigger leads. So they're going to tell other car loan companies for a price that you just applied for a car loan, so that then they can call you and try to sell you their car loan. Same thing in the mortgage world. If you have a buyer that's out shopping, if I pull credit, the credit bureaus can sell that information, and for the next day or 2, they may get blown up with phone calls if they're not on the do not call list. So, the credit bureaus make money there. They make money selling leads. So you can buy leads from the credit bureau. They make money front, back, left, right, selling all of your personal information and credit information, primarily for marketing purposes. So mortgage companies, loan companies, credit card companies can basically reach out and try to sell you their services. Now, a creditor can also choose which credit reporting agencies they report to. We talked about, they pull from one, but they don't have to report to all three. That's why we pull all three and not just one. Because they can choose, we need to know all information. So let's say you go to a small local credit union. It costs them money to report. That's another way the credit bureaus make money. Not only do we have to pay for the credit bureau, we have to pay to report information to the credit bureau. So if you're a small bank or credit union, you may not want to pay to report to all three. Maybe you'll just pick one or two, so it can be slightly different information. That's why we look at all three, and that's why as a consumer, you need to watch all three. If you have some sort of credit monitoring, you may have credit monitoring watching your Equifax, and it looks great, but there could be significant issues on Experian and TransUnion that you just don't know about. So it's important to watch and monitor all three, because you don't know when you're applying for a credit card or a bank loan or a car loan, which credit bureau they're going to use. And then when you're applying for a mortgage, we're looking at all three, and information can be different. Okay, we're going to hit this one early. This is something we get all the time, we hear all the time. Probably the number one question or concern with credit scores is, hey, what do you mean my credit score is X? I looked on Credit Karma this morning and it said my credit score was 20 points higher than that. We hear that all the time, and particularly Credit Karma, and I think it's just because that's one of the most commonly used credit monitoring services. And there is number one answer for that is Credit Karma isn't a credit bureau. We talked about that. You can only get your credit scores truly from Experian, Equifax, and TransUnion. Credit Karma has a representative model, and it's based on FICO score 8. So for mortgages, in the mortgage world, we use one of the different credit scoring models. As we said, there's like 52 models. Now, not all of them are in regular use, as we see on our screen. Now, here's the most commonly used credit scoring models. So the most widely used version of all of them is the FICO score 8. When you go to Equifax, Experian, TransUnion.com, that's generally the credit score information you're getting. When you get your emails with your free credit score information, it's generally the FICO score 8. If you go to buy a car, they're probably using that. They could also be using some of the others, the 2s, the 5s, the 4s that are on there. So I don't need to read all of that to you. But if you look, significantly different is the versions used in mortgage lending. Experian, we use FICO score 2. Equifax, we use FICO score 5. And TransUnion, we use FICO score 4. Those are geared towards mortgages, specifically looking at the risk-based factors for borrowing, really over 30 years, but remember, with a focus on the first 24 months, because 2-3 years from now, maybe we can predict. 10 years from now, we can't predict your life. Life happens. We all know that. Things change. But it's at this snapshot in time, what is the likelihood of repayment of your mortgage loan? And that's going to be different than a credit card or a car loan. And they look at that data and study it and have actuaries that come up with all of these models based on people that generally pay their mortgage on time and people that may have issues. And as we talked about with the mortgage credit report, we pull all 3 credit bureaus and we use the middle score. So we come up with one credit score. Your auto loan, your credit card, they'll probably only pull one credit bureau and have one score. So your middle score is the elimination of the top score. So your highest score we get rid of, your lowest score we get rid of, we keep the one in the middle. So let's say your Experian credit score was 720, your Equifax credit score was 700 and your TransUnion score was 690. We're going to get rid of the biggest one. We're going to get rid of the lowest one. We're going to use the 700 that's left, that's in the middle. And we use the lower credit score of all applicants. So if you have a borrower and a co-borrower, we use the lower of the two people. Your credit score not only impacts your approval, but we do look at way more than just the credit score. We're going to look at the credit history itself. Your credit score is just an indicator, as we said, like your letter grade, but a numerical credit grade. We do look at the credit score itself, and we use the lower of the two applicants because if we're using income from both applicants, they're both as obligated on the new mortgage. So it's going to be really the one that has more struggles is the one we're going to use as the judgment of likelihood of repayment. So this is the number one question we get. I wanted to hit this right away. And then you may be asking, okay, so if when I pull my credit and do my personal reviews and all of that, I'm only getting the FICO score 8, how do I see what your mortgage credit score is going to be? How do I get the Experian to the Equifax 5 and the TransUnion score? Well, that's a great question. And to my knowledge, there's only one place to get it. It is myfico.com. I am not promoting myfico.com, but it is actually the website set up by the FICO system itself. This is the one place where consumers can get their actual mortgage credit scores without applying for a mortgage. It's myfico.com, and it's actually FICO's website, and it is absolutely more expensive than any other option for credit scoring, credit monitoring, etc., but it gives you a lot more information. So if someone is looking to purchase in the near future and wants to really know what their true credit scoring is, they have several options here. A basic, so you can get just a really basic information of one credit bureau from Experian, and it'll give you your mortgage info, but that's probably not all the information you need. Your advanced, you get complete coverage for all 3 credit bureaus. It only updates every 3 months, but you get your scores for mortgages, auto loans, and more. It's like a 50 or 60 page report. It's a ton of information, but if they're serious, then they can get their true mortgage credit scores. And then their Premier, it updates every month, and that's about $40 a month. So just as a resource, if people want to know where I really can get my mortgage credit score, there you go. Who supplies information to credit bureaus? Great question. Your credit bureau is made up primarily of what we call trade lines. So that's information reporting your payment history, etc. It's reported by a creditor. So that's a person, an organization, a company, a government agency that you may owe money to, and they are reporting that you owe them money, how much you owed, and the history, including your payment history. We often call them a creditor, but the term creditor, as we see on here, derives from the notion of credit. As far as trade lines go and creditors, we often get asked, how many credit trade lines should I have? Does my buyer have enough credit? What impacts those credit scores? We're going to get into a lot of what impacts credit scores and how to improve them. And there can be a fine line between too much credit and not enough credit. Having 4 to 6 is a great number. If you have more than that, it's fine, especially if they're aged, they've been on your credit for a good long time, and if they're being managed well. The longer you have credit, the longer you have accounts open, it helps your credit score and credit rating. On the flip side, you don't want too much new credit. New credit pulls your credit scores down. When you open a new account, it temporarily pulls down your credit score and overall credit rating because the credit bureau doesn't know how you're going to repay that. It's a higher risk time in your credit world. So if you go out and purchase a car for about probably the first 4 to 6 months, you're going to see a drop in your credit score from that new account until you've started to establish a good on-time payment history. Then you're going to see credit scores increasing, probably above where you were before you opened that account. Another type of information that can be supplied to the credit bureaus, this is typically for folks with limited credit, people trying to build credit, is alternative credit references. Now in the mortgage world, we can use alternative credit references, even like, utilities and cell phone and car insurance that we can use outside of the credit report just to help build what we call a non-traditional credit profile. But you can have some alternative things added directly to your credit report that will impact your credit score and overall credit rating. Those things include rent. So if you are a renter and making good on-time payments, depending upon who your landlord is, you may be able to have that information added to your credit bureau. If it's just a private party, it could be your Uncle Tom or Aunt Sue. So that won't report. But if you're using a professional property manager or live in an apartment complex, a third party, independent party that you're making your rent payments to, you can have that information added to your credit bureau if they're willing to help and assist. And I'll give you a resource for that when we wrap up today. And you can have utilities added to the credit bureau. Experian, it's called Experian Boost. They have a service where you can add utilities and it only reports to Experian, but it's an option to get some credit going, at least with Experian. Next, let's talk about credit vendors. We're just going to hit this real quick because not really significant in your world, but there's a middleman for banks, for mortgage companies, for car loan companies. A credit vendor buys the information from the credit bureaus and sells it to banks and lenders like us. So we use a credit vendor, a middleman. Ours is called Funding Suite. There's a bunch of them out there. And the credit vendor, we are their client, so we pay them. They take the credit bureau information, they merge it into the one credit report, then they sell us that credit report to make our loan decision about credit approval. But they can also do some cool things such as like what if simulators, or how do I get this credit score? So if I pull a credit report, say I have a first-time home buyer that wants to get down payment grant funds from Virginia Housing, formerly VHDA, and they need a minimum credit score for that of 640, but they're only at a 620. I can go into the online system and with their credit report, I can say, okay, what do we need to do to get them from a 620 to 640? And it'll say, okay, here's what you do, and here's how long it'll take. They can also do what we call a rapid rescore. So we'll talk today about disputing information, updating information, the impact it can have on your credit score and overall credit rating. A rapid score is a way to basically to back channel that to make it happen immediately. So if we can get documentation that something on the credit report is incorrect or just different, we can request a rapid rescore where it happens generally in 24 to 48 hours versus waiting several weeks for things to be updated with the credit bureau. All right, let's talk about a quick credit flow chart. Here's how credit works. And it's kind of a circle here. We'll start with client receives the loan. So once we open a new loan, the creditor reports that information to 1, 2, or 3 different credit bureaus. The credit vendor, that's the middleman, then buys that information and compiles it down into one credit report. Then the bank, the mortgage company, whoever buys that credit information to make a loan. Then the client receives a loan, and that's basically the never-ending circle of how all that works with the middleman. Okay, next, reading a credit report. We're going to cover this quickly because all credit reports are different. When you pull your own credit report, you're going to get a credit report that looks like whatever vendor that you use to pull it. Same thing with us. When I pull a credit report, the one that I look at, we actually have two different credit vendors we work with. They both look different. So depending upon which credit vendor you choose, your credit report's going to have a different format, but it's all going to have the same general information. It's just how it looks, how it's presented. So one of the first things you're going to see on your credit report is your personal information. It'll have your name, your address, including previous addresses, your date of birth, your social security number, employer information, and any aliases you may have, any other names you may have gone by. That's usually either at the very top, the very front of the credit report, or at the very back of the credit report. And it'll show any, variances. So say for your social security number, if anybody's typed in your social security number wrong, it'll show different variances in how your social security number was used to pull credit. Addresses, it'll show a history of addresses that have been used. You can update your personal information if you're taking a look at your credit and you notice something is not correct, like you no longer live at such and such address, but it's saying your current address. You can basically dispute or request an update to that information. You can do it just like you're disputing anything else. You do it online. You can send them a letter. If you send them a letter, then I usually send proof, like copy of my driver's license or something of that nature. But you can update all of that information with the credit bureaus. Is it critical you do that? Not really. It doesn't impact your credit score and credit rating. But if you want to do that, you can update it. All right. So your credit report, this is the sample of the first page of a credit report. It has the information that we use to pull that credit. It shows their names. Obviously, this is just a general sample. These aren't real people and not real information, but it'll show information on who they are, the most recent address, social security number. Your date of birth may be on here or later on the report. Then you're going to start to look at some of the credit variances. So we talked about like your date of birth, your social security number. If you don't see it here, it'll probably be on the last page of the report, but you can look at the information that's been in there. And again, it's not critical that that's perfect. Now you're going to see credit scores. That's usually towards the front of the report because that's usually what we look for first. So if we pull credit and we see that their credit score is in the 400s, we know, probably going to have some issues. If we know their credit score is in the 800s, this is probably going to be pretty clean. And it really impacts how we're going to look at that credit report. We talked about the middle score. It's not an average. We basically throw out the high score, we throw out the low score, and we use the one in the middle. In this example, the highest score was a 659. The lowest score was a 597. So we're using the 633. Ooh, I didn't mean to do that. Let's see. Actually, yeah, we're cool there. Okay, next page. You have your trade lines. So once you get past the credit score itself, you're going to see all of the accounts that are showing that are open and active, or even older and paid and closed. And it's going to show some basic information and terminology on each one. So you're going to see information on ECOA and who it belongs to. ECOA stands for Equal Credit Opportunity Act. Now, I'm not quite sure why they call it ECOA, because really this indicates who it belongs to. And the codes are B for borrower. So if you have one person on the credit account, you're going to see mostly just Bs. If you have two people, a joint credit account, it has to indicate who that specific account belongs to. So it may say B for borrower, C for co-borrower, the second person on the credit report, J for joint if they're both on the same account, or A for authorized user, meaning it's someone else's account. I'm just an authorized user on their account. Next, it's going to show the creditor, who you borrowed money from, who you owe money to. Pretty simple stuff. And later on the credit report, it will show contact information. Some credit reports show it right there. Usually it's later in the report where we'll say, okay, for Barclays Bank of Delaware, here is their address and phone number. That is a helpful tool. If you don't recognize something on your credit, you can contact the creditor themselves and say, hey, what's this? I've never heard of you. This isn't me. Date last reported. This is significant. So the date last reported indicates the last time the creditor updated their information with the credit bureaus. So in this case, this is an older one. It was last updated in September 2015. So the date of this credit report is probably in September 2015. This is just like an old template that I had. But anyway, the date of last activity is important in making sure that information is reported up to date and current. So for example, when we are looking at a credit bureau, if the information hasn't updated in 4, 5, 6 months, we're going to want to know what's up. So we're going to ask for an update to bring that information current. And we request that from our middleman. We do what we call a credit supplement. So in this case, if it's old information, they would contact Capital One and get an update on payments, balances, etc. since the last time it reported. This date reported and date of last activity, which we'll cover in a minute, is critically important on negative items, especially at collections and charge-offs. Date open, obviously, is when the account was opened. Date of last activity is the last time something happened on the account. This is also important. So in this example, we're looking at the Capital One. The date last reported was September. The date of last activity was August. So it means something happened in August on the account. Could be a payment was made. Could be a charge was made. Just something happened. If nothing happened, that date of last activity could be kind of old. So let's say you have an old credit card that you're really not using, zero balance, but you just let it hang out on your credit, which is good. It's good for your credit. Your date of last activity could be 6 months ago, could be 12 months ago, even though your date reported is current. If you haven't done anything on the account, that date of last activity could be fairly old. Credit limit or highest credit. On a credit card, that tells you your credit limit on that credit card. On that Barclays Bank, we see a credit limit of $4,700. Now, if we look just to the right of that, the balance is $4,368. That could be one of the reasons why this person's credit is less than perfect, because balance versus credit limit is important, and we'll talk about that. If it is not a credit card, then it's the high credit. So it's like the most it's ever been. So if we look just above it at the Kia Motor Finance, you see the high credit of $24,170. That would be the most it's ever been. So when they open the account, that's how much they finance. That's where it started. And they have since paid it down to $23,420. And they're paying that one well, paying as agreed. Account type lets us know just that, what kind of account it is. We can see the Kia Motors is an auto loan. Revolving is something that stays open and active. We'll talk about that. It can be installment. We'll talk about some different types. It could be a mortgage. There's a different category for like an American Express where it's due every month. So it just tells what type of account it is. And it's good to have a mix of accounts. We see the balance. We see the terms. Terms is generally your monthly payment, your minimum payment. So on a credit card, it's going to report basically your minimum due. You can always pay more, but obviously you don't have to. So they're going to report the minimum. It may even say the number of months. So if you look at that first rating, the Kia Motors Finance, it says 075. So that's a 75-month term at $387 a month. Past due is how much is past due right now when you pull that credit report. So these are $0 past due, meaning they have nothing past due right now. If they were behind, it would indicate how much is past due. Then we see a delinquency history, that 30, 60, 90 there. It shows if the account has been delinquent in the past and how much it was delinquent. So the Kia Motors has been late 0 times 30 days or more past due, 0 times 60 days or more past due, and 0 times 90 days or more past due. We do see on here, we highlighted in gray, the Chase card right here. They did have one late payment that was 30 days or more past due. And then it'll show down here under the late dates, the last late date was February 2010. So we're looking at a credit bureau here from 2015. So it's 5 years old. That one late payment from 5 years ago really isn't having a huge impact on credit scores. What has the most impact on credit scores is what's most recent. So what's happened in the last 12 to 24 months is the biggest indicator of your person right now, and has the biggest impact on your credit scores. Who you were 5 years ago isn't who you were today. 5 years ago, you may have been selling timeshares or working in a CVS or, who knows, great jobs, wonderful things, but you weren't a superstar realtor yet. Since becoming a realtor a few years ago, guess what? You're crushing it. You're killing it. You're just in a different place in life. So what's happened in the last year or two is the biggest indicator of where you are now. And it really is the biggest thing that we look at when making a loan decision. We're going to be the same with a credit card or car loan, anything of that nature, but it's also the biggest impact on your credit scores. Next, you have your MOP ratings. So it's basically, it tells you the current status of the account. You can tell a lot about each item by the rating there. And the main part we're looking at, because the why there, that it's different with different mortgage types or different trade line types. Generally, it's going to be an R dash whatever, an I dash whatever, an O, which would be like the American Express. It stands for open, or M for mortgage. The number behind it indicates the status. So we're going to look at what all of those are, but that's just kind of, you'll see the status that is important on the credit bureau. And as we mentioned, for a revolving account, it's going to be an R. For an installment, it's going to be an I. O for open, M for mortgage. Those are the most common that you would see. Then we have manner of payment. And again, this is the current status. So you may see a 0-0, means, hey, they just opened a new account, probably haven't made a payment yet, too new to read. The one we see the most, or at least we hope to see the most, is a 0-1, means it's paid as agreed. 0-2 means at the time of this credit report, it was 30 to 59 days past the due date. 0-3, 60 to 89, et cetera, et cetera. 0-7 means it's paying or paid under a wage earner plan or similar arrangement, aka a bankruptcy. 8 is a repo, and then sometimes we see the letters BABD, BP, BR, not quite as common. And then number 9 is not great. It means a charged off to bad debt. So that means it was written off either as a collection or a charge off, and we'll talk about the differences between those two. Common inaccuracies on your credit report. So some of the things that we see on that current status, or even in general, is if someone declared a bankruptcy, that creditor still listed as a collection or charge off instead of in a bankruptcy. Same thing with foreclosures. If your mortgage is showing as a 2 through 5, but it was in a foreclosure, it should be updated as an 8. Accounts with past dates not rated as 1 still showing as past due. So if you've gotten something up to date and it hasn't reported as up to date yet, that's another inaccuracy. So let's talk about inaccuracies. Life happens. It happens to any of us. We go through stuff we would have never expected. We never judge. None of us should ever judge. We never know what someone else is going through, has been through. You can have excellent credit for a lifetime. Stuff happens. And guess what? Life changes. It happened to me. I went through a separation and divorce, completely unexpected, and it had an impact on my credit. That typically has an impact on credit. As a consumer, you do have rights under the Fair Credit Reporting Act to dispute things that are inaccurate. And the way credit repair and improvement companies do it, they'll dispute anything and everything that's negative just to try to get it off of there, get it out of your credit scores. So under the Fair Credit Reporting Act, the credit bureaus report information that is 100% verifiable, 100% accurate, and when you challenge or dispute the credit items, they have to respond in a reasonable amount of time, typically 30 to 40 days. So if you think there's something inaccurate on your credit report, or it's just something negative and you're like, look, I'm not sure this is supposed to be on there, then you can do a dispute. So the credit bureaus then are supposed to contact that creditor and verify that information, making sure that it's accurate and that it's verifiable. Now, the credit bureaus get so many requests, they really don't truly do all of the legwork and verifications that they're supposed to. So a lot of times you're just going to blow off your dispute and you have to go back to them over and over again, multiple times. But you do have the right to dispute any information on your credit. So if you have a public record, you can ask, hey, is this really mine? Can you verify this is truly mine? Can you verify the balance? Like they have to prove it or remove it under the law. Tax liens, they don't really show up on credit. On most credit bureaus, we don't see tax liens anymore. We don't even see some of the public records anymore. Like it used to be, we would see judgments, tax liens, all of that. Because there was so much inaccuracy, so much being reported that really wasn't the right person, the credit bureaus just said, forget it, we're taking it all off. Now, we're still going to find that information. We do what we call a fraud report, and it pulls up all kinds of information. It's kind of spooky when you think about it, just the information that we can pull on that one quick report about everyone. But tax liens, you can certainly dispute that information if you see it show up on one of the versions of the credit bureau. Just the one that we use doesn't have that information. You can dispute late payments on open accounts. A 30-day late can cost you 50 or 100 points. Now, the problem with disputing an open and active account is if you dispute it, the next time they report, they're going to report the entire history again. It's probably just going to show back up. So in those cases, you probably have to talk to the creditor themselves and try to get them to remove it. If you were indeed late, but have a really good reason, you can appeal to them, do like a hardship appeal. Say, hey, look, I've been a customer of yours for 10 years. Had such and such a problem, and can you please take that off? And they're allowed to do that. And then as you're looking at credit, revolving accounts, you should take a look at those too. And you want to see that they are reporting to all three credit bureaus for the best credit mix. So if you have something reporting, revolving or installment, and you see maybe one of the credit bureaus it hasn't updated to for a while, you can do a dispute and have them update that. I personally did that just like a month ago. I banked with First Advantage, and I saw that with Experian, they had not reported the updated balance and payment history since September. So I went to Experian.com and did a quick dispute, and within days they had it all updated, and my credit report and credit score was all updated. So how to dispute? You can do it online. That's where most people do it. So you can go right in if you have credit monitoring, or you can go right into one of the credit bureaus, or using your annualcreditreport.com. We'll talk about that. You can file a dispute online pretty quickly and easily. You can mail a letter. So you can type out a good old-fashioned letter and mail it in. That's even better when you have like proof. So if you have a payment history to show it never was past due, mail it in with a letter, and then they have to verify it. Now that's definitely going to be slower because they have to pay people to sit there and open all that mail and do all that, input the disputes. But it is a very effective way to make a dispute. You can contact the creditor. You can contact the credit bureau. You can call a 1-800 number. Now, calling that 1-800 number is not going to be easy. It's tough to get through, and they're just contracting to some telemarketer somewhere, but it's possible. One of the key things on disputing and requesting corrections to inaccuracies is disputing it with all 3 credit bureaus. As we mentioned, there's 3 credit bureaus, and if you dispute inaccurate information that's reporting to all 3, then if you only dispute it with one, it's only going to update with one. It's not going to update to the others. So as we can see here, we're looking at information that's incorrect, and this one is reporting to Experian, Equifax, and TransUnion. If you don't dispute it to all 3, it's only going to update to the ones with whom you disputed. Now, if it's only reporting to one, then you just dispute it to that one, not all 3, because the other ones aren't going to know what you're talking about because they don't have that information. So that's where it's important to see which credit bureaus are reporting wrong information and correcting it with that appropriate credit bureau. This is how your reporting should look for a bankruptcy item. We're just going to cruise through this. All right, collections, and we'll talk about charge-offs in just a moment. The number 1 disputed item on credit are collection accounts, because that's probably one of the biggest things where there's errors. So the collection agency may not have your Social Security number, may not have your date of birth, depending upon who that third-party original creditor was. So more than 40% of all disputes with the credit agencies are for collection accounts. A collection account's filed when the debt goes into a delinquent status. The most common one we see is medical collections, and that's very frustrating. I hear tell of some of the local medical service providers that will send you like one bill, and if you don't pay that one bill, they just turn it over for collection. Then the collection company will contact you. Usually they say, hey, pay us this, or we're going to report it to credit. So usually they do give you a chance because number 1, their goal is just to get paid. But number 2, they have to pay to report that. They don't want to do that. So collection items are the most common thing, and they can have a huge drop in your credit score if it hits your credit. Now, one of the biggest things that we get challenged on, questioned on when it comes to impact on credit scores is, hey, I paid that collection off. Why is it showing in my credit score? Well, the collection's dollar amount doesn't factor into the credit score. Meaning, if it's a collection for $0, $500, or $10,000, they would likely impact your credit score exactly the same amount. The key is date of last activity. How old was it? So a $0 collection from 3 months ago is going to have way more impact on your credit than a $10,000 collection from 5 years ago. So date of last activity is the biggest impact on your credit rating on a collection account, way more than the balance. A charge-off is similar to a collection in that, hey, you didn't pay this bill, but a charge-off, really, it's still owed to that original creditor. So a collection means a creditor, primarily medical is what we see, just said, you know what, forget it. I give up on this person. I'm selling it to a collection agency. Let them deal with it. It could also be like a utility. There's a lot of different folks that will turn you over for collection. A charge-off means the original creditor still has it. They just have written it off as, it's probably not going to be collectible. So that balance is still yours with that original creditor. So if you say went to Big Bank USA and borrowed some money, didn't pay it back, after a certain amount of time, they're going to convert it into a charge off. They write it off as a lost debt. They write it off as an expense. So they save money on taxes, and you still owe them that money though. And you're probably still accruing interest on it, depending upon the terms of your agreement with them. Now, a charge off, that is impactful on getting a mortgage. Collections, especially medical collections, we pretty much ignore, but they do impact your credit scores. A charge off, we do pay attention to, especially if it has a significant balance, and often you'll be required to pay those off. And if you do not have the funds to pay them off, you can work around that. Because it is with the original creditor, you can contact them, make a repayment arrangement, say, hey, sorry about that. I had a tough time back then. I want to make good. What can we settle on? So let's say you owe them $1,000. You can call and say, hey, how about I agree to pay you back $500 at $50 a month for 10 months? So that's fine. If it's a written agreement that will satisfy the debt, even if it's settled for less than the full balance, that is okay. We're just then going to count that new payment in your qualifications in figuring out your affordability. So we're just going to add that $50 into your monthly payments. Statute of limitations, we're just going to cover this kind of stuff kind of quickly because this isn't necessarily credit report related, just more debt related. There is a statute of limitations on debt, on how long they can come after you for money that you owed. And there's a difference between the statute of limitations for collection of a debt and for reporting of that debt to credit bureaus. So for an example, let's say you borrowed some money and did not pay it back. So let's say, what are we in 2021? So let's say you did it in 2016, so 5 years ago. So you borrowed some money and never made the first payment. For statute of limitations, meaning how long they can come after you, depending upon the type of account, etc., it's generally going to be about 3 years from the last activity on the account. Now, on your credit report, it's going to report much longer. It's most likely going to show up there for about 7 years. Doesn't mean the creditor can go after you. And you may see that if you have an old collection item, it could be 5 years old, 10 years old, whatever, you may still get letters from a collection agency wanting you to pay it, wanting you to settle, but they will have to put on that letter that they cannot legally enforce that through the courts. They can't take you to court and try to get that money back. It's exceeded the statute of limitations. So you technically, legally aren't obligated, but they still want you to pay it. So very few people read that fine print. So that's what they're hoping, and hope that oh, maybe they'll settle it because they think it'll help their credit, etc. Here in Virginia, this references the Virginia Code, and it really just states that if you have not had any activity in the last 3 years, then you typically cannot file a suit against a consumer. And that's really the only way to truly get the money back. You can, of course, voluntarily pay it back, but if you refuse to pay, they would have to take you to court. Could be small claims court, could be a circuit court, just depending upon the amount that you owe. If the debt's based on a written contract, the statute of limitation period goes up to 5 years. And then, as you can see, domestic judgments or those obtained in a Virginia court of law have a collection period of up to 10 years and may be extended. You would have to go back to court for as long as 20 years. Okay, inquiries. This is a great question. We get it a lot. People are like, oh, I don't want you to pull my credit. I don't want it to hurt my credit scoring and credit rating. It really doesn't. There's a thing called a soft pull. That doesn't hurt your credit at all. That's when you pull your own credit monitoring, Or if you're getting homeowners insurance, they check credit. If you're going for employment, they check credit. That is a soft pull. A hard inquiry is when you are seeking credit. And in general, a hard inquiry has very little impact on credit scores. If you have excellent credit, upper 700, 800s, it may have zero impact. The credit inquiries really don't hurt as much as people think. It's 0 to 2 points per inquiry typically. And if you have an 820 credit score and lose 2 points, no one's going to care. If you're above 740, you have exceptional credit. But it's usually the people that have a 790 credit score that are most concerned about it. Really have to be more concerned if somebody is like right on the bubble, right on the borderline. And when you have lower credit scores, it can impact it. Now, the credit score, the number of inquiries impacts your credit score, especially depending upon what you're doing. So you're going to have some more significance from an inquiry if you go apply for 10 credit cards, because you theoretically could apply for and get 10 credit cards and then just declare bankruptcy on all of them, versus if you have multiple car loan inquiries or multiple mortgage inquiries. If you're car shopping or mortgage shopping, they don't have anywhere near as much impact. Some credit scoring models have no impact for a set amount of time, generally about 15 days, but the credit scoring models that most people use in reality, shopping for cars, shopping for mortgages, will have a little bit of an impact, especially if you do multiple inquiries, but it's really, really minor. And unless you're on the bubble, it doesn't matter, and it doesn't last long. If you don't open new credit, within a few months, the impact of that credit pull is going to disappear, because they know you're not doing anything, so there's no risk. So it's just going to go away. Your credit score is going to rebound, like I said, within a few months, most likely, and it'll be like it never happened. And if you don't open new credit, it doesn't matter what your credit score is. Your credit score only matters if you're applying for something or trying to open new credit. Okay, we've hit 10:30. If anybody has to hop off, I know everybody's busy. We all have very busy lives. Certainly understand that. We are recording this. You can go back and finish it later. But there's still a lot of really good information here, so hopefully everybody can stick around. Okay, next, in credit, your credit score, credit rating, the most important thing is revolving accounts. That is stuff that you use over and over again, like credit cards, lines of credit, home equity lines of credit. There's a lot more risk associated with revolving accounts because you have it forever and ever. You can use it as you pay it down. You can push the balance back up. With a closed-end installment loan, set repayment, your balance is consistently going down. With a credit card, they're not. And your credit card companies will monitor your credit constantly, your overall credit, your credit scores, etc. They may do it to offer you higher credit limits and whatnot, but they're also going to make sure that there's not other problems. If they see you're having significant credit problems in general, they may cut your credit limit. So revolving accounts have, because they're the biggest risk, they can have the biggest positive impact on your credit rating and credit scores. It's way more than an installment account. So one thing we always suggest on revolving accounts, your credit cards especially, is watch your balance at all times. You don't know when they're going to report to the credit bureau, and it can be different dates for each credit bureau. For example, if you have a credit card with your local credit union or whomever, and you're like, look, sure, I use it. I have a $1,000 credit limit. Yeah, my credit, I have it. I owe $900 right now, but as soon as I get my statement, I'm going to pay it off. Well, it doesn't work like that for credit reporting. They're going to report at a specific date each month, and it can be different dates for every bank and credit union, because the credit bureaus can't take data from every creditor in the entire country all on the same day. It would just be overloaded. So they spread it out, and it can be different dates for each of the 3 credit bureaus. That's why we stress, when you are working on credit, when you're working on your credit scores, all the time, you watch your balance versus credit limit, because you don't know when it's going to report. Another big question that we get, should I close my credit card accounts? No, probably you shouldn't. Length of time you've had accounts open is really important to your credit score and credit rating. If you've had accounts open for 5 years, 10 years plus, that's when you're going to see some of the exceptional credit scores. And having available credit, your balance versus credit limit, that's also a big plus to your credit score and credit ratings. So your ideal credit report will have revolving accounts. They'll have them open for a long time. They'll have a low balance versus the credit limit. And it's okay to have a zero balance. The different credit scoring models judge that differently. Some scoring models do want to see some activity. So if you have an account that's old, it hasn't had any activity in a year, it may not be having much impact on your credit score. If you charge 25 bucks and pay it off every month, charge a tank of gas and pay it off every month, that'll overall help your credit score and credit rating for a lot of the credit scoring models. So, if you have a 790 credit score, it doesn't matter. If you have a 660 credit score, maybe you want to, just make a charge and pay it off. Make a charge and pay it off just to keep the activity going on that, and maybe even pay it down to $1. That way it keeps some small balance. Some of the credit scoring models like to see just some teeny tiny balance on it. And if someone has no credit, a revolving account is the quickest way to get started with credit and getting a good credit score. Now, ideally, you want to see more than one account and more than one rating, but hey, we can work with one. So if you get one credit card account open, you manage it well within probably 6 months, maybe sooner if you're lucky, then you're going to start to see some good credit scores coming through, and we can build from that. Some of the non-traditional or alternative credit trade lines and references that we mentioned, and a secured credit card is okay. So there's a lot of credit companies that will give credit to just about anybody. It's not a lot, and it's going to be at a high interest rate and high cost, but they'll report and they'll help you build credit. And if not, you can get a secured credit card. So you give your bank 500 bucks, they give you a $500 line of credit. It's really zero risk for them, and they'll report that to the credit bureaus. So it helps you build your credit score and overall credit rating.
Kevin.
Yes, ma'am.
You have a question about
Yes.
this. Does your report show if you pay extra on mortgage or credit cards, and does that impact your score?
It does not show that. Great question. So you can pay extra on pretty much any account to reduce your balance, pay less in interest. The credit bureaus, they just know that you made a payment in a timely manner. They know the balance, they know the high credit. So paying extra, no, doesn't help your credit score and credit rating, other than on a revolving account like a credit card, your balance versus credit limit. So if you're paying extra and increase that available credit, so you're paying extra, your balance goes down, you don't charge a bunch of new stuff, then yes, that'll help your credit scores. But just paying over and above the minimum payment in and of itself does not impact credit scores. Installment accounts. Those basically have a set beginning and a set end, kind of like a car loan or a mortgage. So if you go buy a car, it's for a set amount of time, say a 5-year car loan, you know when your first payment is, you know how much your payment amount is, and you know when your last payment is. You can, of course, pay extra and pay it off early, save yourself some money in interest, but that's a closed-end installment account. They're great. They do help build credit. The credit bureaus and credit scores like to see a mix of credit. So they like to see both installment and revolving accounts for the best credit scores. But as we talked about, revolving have the biggest positive impact. And a lot of what we're talking about here is, folks that have excellent credit, this is certainly stuff to understand, but, this is more geared towards folks that may have some issues, folks that we are trying to work with to get qualified to become happy homeowners. A bankruptcy, it happens to the best of us. Could be due to a divorce, could be due to a medical emergency, a loss of job, things that just happen in life, usually that none of us expect. Now, a bankruptcy can be treated multiple different ways, and the things that we're going to look at is the type of bankruptcy. Number one, there's the Chapter 7. Chapter 7 is, hey, I just can't do this. You file a Chapter 7 and you basically walk away from everything with a fresh start. A Chapter 13, you make payments. So it is basically a debt reorganization through the courts. Typically, I see repayment terms of about 5 years. So, the courts will put together your bankruptcy trustee, a repayment plan, looking at the different debts and obligations that you have. You make payments through the trustee, they disperse it to those creditors. So the creditors get some money back, depending upon your situation, your income, etc., determines whether you qualify for the 7 or 13. Now, when we talk about waiting periods, it's going to be different between a 7 and a 13. So a Chapter 7, which is your total debt forgiveness, except government-backed debts. Of course, when the government put in the legislation for a bankruptcy, it allows you to write off everything except for them, except government-backed debts. For Chapter 7, we use the discharge date. So when everything is done. So when you've been through the bankruptcy, usually it's about a 3-month process. Your discharge date is when we start your waiting period to I guess basically start over. Your Chapter 13, as we mentioned, is your restructuring of your debts. Your Chapter 13, we go off the date it's filed. So let's say you start a Chapter 13 bankruptcy and it's a 5-year repayment plan. When you apply for a mortgage, we're going to look at the date the Chapter 13 bankruptcy started, and it really doesn't even have to be discharged. In theory, you can get a mortgage, purchase a home while still in your Chapter 13 repayment plan. You have to get approval from your bankruptcy trustee, and you do have to show you have good reestablished credit, but it's possible. I've never actually done one. I've been doing mortgages since '94. I've talked to people about it. I've never actually seen it happen. With a Chapter 13, really, it's better to have it discharged. So with a Chapter 13 means you paid it back, you get it discharged, and by then you probably have some decent credit reestablished. So your bankruptcy type is important, and it's important in your waiting periods, but we also talked about life happens. So in a bankruptcy, a foreclosure, some of these major items, we're going to ask why, and that can impact your waiting period. So it says most programs require a client to be at least 2 years out of a bankruptcy discharge in order to finance. That's 2-year mark is generally if you have a good reason for the bankruptcy, and generally one we can document. So that's going to be, I had an accident and couldn't work. Something outside of my control. I had a significant medical issue, and we would say, okay, provide an accident report, provide something showing, some medical bills confirming the illness or whatever it may be. Divorce, it depends. So on an FHA mortgage, they do not allow a divorce as what we call an extenuating circumstance. For a conventional mortgage, they will allow a divorce. And that's one of the big things we see that impacts credit. So there's it depends on a bankruptcy, but in general, you're looking for at least 2 years. And that 2-year mark, we really want to have some pretty good reasons why you went bankrupt. That, hey, stuff did happen outside of my control. It was my only choice. Otherwise, you may have some longer waiting periods. Really kind of the same thing for a foreclosure. In general, most loan programs require at least 3 years out from a foreclosure, and that's with a good reason, good extenuating circumstances before they can get a new mortgage. Now, if someone had a bankruptcy and a foreclosure, we can now go off the bankruptcy. So if you declare a bankruptcy and it includes a mortgage, that ultimately goes into a foreclosure, we're going to use the bankruptcy because usually the waiting periods are less than on a foreclosure. A true foreclosure, as we know, is when the client walks away from the home, no repayment plan in place. Here you go. I'm out. And that's really when the sheriff's sale happens. And, oftentimes the client's responsible for any deficiency balances. If they sold the house and lost money, they can go back to the client unless they've declared bankruptcy. If someone's in this mess, they should be talking to an attorney at that point. But when it comes to waiting periods, we're going to look from 3 years from the completion of that foreclosure. When everything was done, the house was sold at auction and taken out of their name. A deed in lieu of foreclosure is when the consumer makes a deal with the bank. Hey, I can't afford this house. I'll just sign it back to you. So the bank doesn't have to take legal action. They just basically hand it back to them, give them the keys, and go about their business. You're going to look at the same general foreclosure waiting periods, but it's going to be a little bit more of an extenuating circumstance. So, if you're right at that 3-year mark and, there's really not much of an excuse for the foreclosure, we're probably not going to be okay with it. With a deed in lieu of foreclosure, we're much more likely to be okay with it. And then a short sale, again, you're going to end up with waiting periods, very similar waiting periods, where the consumer agrees to basically, agrees with the bank, the mortgage company agrees to take less. So let's say you owe $100,000 on the house, but you can only sell it for 90. Then the mortgage company says, okay, fine, we'll take the 90 and let's call it a day. So the mortgage company is still losing money. You're still not paying as agreed. So that does still have a negative impact on credit score, credit rating, but also your ability to get a new home. Public records, these are the things that show up in a public records section of your credit report. Bankruptcies, they do still show up on your credit report. Judgments, not so much, not on the credit reports that we use. So your judgments, as I said, there was too much misinformation, so they just pulled them all off. And tax liens, they rarely show up on credit reports anymore either. They may be reported by the IRS or even your State Department of Revenue, but they don't show up that much anymore. Credit score. Let's talk about what goes into your credit score. Your credit score is a complicated animal, and it's different with each credit bureau, and it's different with each credit scoring model. But in general, these are the things that make up your credit history and your credit score, your credit rating. So 10% of your credit score is new credit. So that's the number of recently opened accounts, the number of recent inquiries. So as we can see, an inquiry is only this entire category is only 10% of your credit score, and inquiries are just a small portion of this. So a credit inquiry has very little impact, and the time since your credit inquiry is important. Like I said, within a few months, it doesn't matter anymore. But this is where you'll see if you open a new account, it will have some temporary decrease in your credit score. The type of credit, we talked about that. You want to have a good mix of credit. Now, this is, again, only a small percentage, 10%, but if you have a variety of accounts, such as credit cards, retail accounts, installment loans, consumer finance accounts, having a good mix shows that you're able to manage different types of credit, so that helps boost your scores, but only a small part. Payment history, this is a big one. Do you pay your bills on time? So, obviously, that's going to be a big part of your credit rating. So it's going to look at the different account types. Do you pay your bills on time? If you had a late payment, how long ago was it? How far past due was it? A 30-day late from 5 years ago isn't going to have much impact on your credit score. A 30-day late 6 months ago or a month ago has a huge impact. A 60 or 90-day past due will trash your credit score, especially if it's recent. So watching that payment history is the #1 most important thing to make sure that your credit rating stays where it needs to be. Amounts owed, we talk about this, the amounts you owe on your account, primarily your balance versus credit limit. It is also the number of accounts with balances, etc. But really the main thing that we see on here is the proportion of credit line used versus your credit limit. It's also the fastest way to boost your credit scores is to pay down those balances. As soon as they update, you'll see your credit scores skyrocket. We see, customers that will pay down even small credit cards. We have a $500 credit limit, $400 balance. Just yesterday, we looked at a customer that had 2 accounts, $500 credit limits, $400 and some balances. We ran the what if scenario. If she paid both of her credit cards down below $100, it would have boosted her credit score by 75 points. That's how big of an impact it can have. Length of credit history. If your account history is only, a few months or even a year or 2 old, that can impact your credit scores. The longer you have accounts opened with good on-time payments, the better it is for your credit, obviously. And this just says don't close trade lines. If you're concerned about credit scores and credit rating, if you're having some issues, the longer you have stuff open, even if you aren't actively using them, it helps your credit score and credit rating. So what is a good credit score? What are the ranges? So there's kind of a chart there. It's pretty obvious to most of us that have any information about credit. The exact credit scores may differ depending upon which credit scoring system you're using. But in the mortgage world, that's what we're concerned about today. And this is a pretty good representation of what good, very good, and exceptional credit scores are. In the mortgage world, generally in a normal world, we're looking for a minimum of a 580 credit score. So that puts you in the fair range. Now, if you've got a 580 credit score, your credit's really not that great. So just because you have a 580 doesn't mean you're getting a mortgage. That's just the minimum benchmark. Now, some of the mortgage programs themselves will let you go below a 580. For example, on a VA mortgage, even an FHA mortgage, you can go below that per the mortgage guidelines, but the mortgage companies aren't going to do that. We don't want that risk. We don't want that borrower. So credit scores, when you hear a mortgage company talking about the minimum credit score, that's just the minimum we will look at to consider someone, but then we're going to look at the credit history. We're going to look at affordability. We're going to look at assets. We're going to look at everything else. So just because you're above that minimum benchmark doesn't mean you are qualified. Now, things are a little different during the pandemic. So a year ago, 580 credit score borrower could qualify and get a mortgage. Odds are today that's not going to happen. As soon as the pandemic hit, we had a lot of employment and income instability. So credit requirements shot up quickly. Minimum credit scores increased quickly back in, what would that have been, like April, May of last year? So right now, most lenders have higher than normal minimum credit scores. From what I hear in general, it's usually about a 620. Some creditors may still go a little above that. Some creditors are decently above that. Some may require a 660, even a 680. And for a couple of reasons. Number one, we talked about, it's a riskier time. People with better credit scores are more likely to repay the mortgage, even if they have some income instability. Something happens with their job. If you have a 780 credit score, odds are you probably have some assets. You probably have some reserves. You're probably going to figure out how to make those payments versus somebody with a 610 credit score, probably going to run into some trouble. So it is risk, but in all honesty, it's also some cherry picking. Mortgage companies, all of us, are so incredibly busy right now with excellent credit people, with refinances, with purchases, with everything. Our volumes are, depending upon the company, 3 to 5 times normal. We've had to hire, we've had to expand, we are having to pay overtime, we've had to double salaries for support people to get them to stay. It's been such an insane time because of these low mortgage rates that we can't keep up with the very good and exceptional credit people a lot of mortgage companies just aren't going to dig into the fair. They just don't need to right now. So that's a big part of it. But in general, your conventional mortgages always have a minimum 620 credit score that's set by Fannie Mae and Freddie Mac. FHA, you can go pretty deep. You can go really down to a 500 per the FHA. You have to make a bigger down payment when you get to those lower credit scores. But in general, your mortgage companies aren't going to go below a 580. Same thing for VA, really no minimum credit score on VA. They're going to look at your credit rating the last couple of years. But, again, typically 580. Right now, you're probably more like 620. USDA, U.S. Department of Agriculture, same people that certify our beef in the grocery store. They have the Rural Housing Mortgage Program. Again, they go pretty deep on credit, 580, maybe even a little lower, a little more conservative right now. USDA is pretty dang flexible on credit, especially with exceptions, etc. They are sticklers on affordability, debt to income ratio. So that's their big thing. And VHDA, now called Virginia Housing, I still know them as VHDA. They set an absolute floor minimum score always of a 620 for any of their programs. Some of their programs do have higher credit score requirements, such as the down payment grant funds is 640 plus. So credit scores are important to meet the minimums. Overall credit rating is important because we're going to look at that too. And they really go hand in hand. If you have a great overall credit history, guess what? You're going to have a great credit score. All right, so let's start to wrap up. I appreciate everybody hanging in who's still in. Let's pull all this together. A lot of this is just going to be a review, but this was on the email that Rita sent out about things we want to cover. So just want to make sure that we cover these in detail. We've got medical collections and charge-offs. Should I pay them off? Can I have these removed? We talked about that. Yes, you can have these removed. You can dispute them through the credit bureaus just to try to get them taken off. Should you pay them off? Probably not. If it's a collection account, really probably not, because if you have a collection account that's 5 years old, odds are they can't legally collect it from you anyway, and it's reporting 5 years ago with a $500 balance. If you pay that off, they're going to update that information to the credit bureau. They're going to show it as a zero balance, but your date of activity, last activity, will have gone from 2016 to 2021. So your credit score, the credit algorithms, is going to see a collection account from 2021. That was the last activity. So paying it off not only will not help your credit score, it could absolutely hurt your credit scores. Credit cards, should I close them out? Probably not. If you're worried about credit score and credit rating, keep them open for a while. Trade lines, does my buyer have enough credit? Probably. And if they don't, we can use alternative credit references. We just need something there generating a credit score, and we can build from that. Adding rent utilities to build credit, can it help the buyer's credit? Yes, depending upon the credit scoring model, and I'll give you some resources for that on the next slide. Student loans. Should we consolidate these prior to making a house payment more affordable? Probably not. If they're not delinquent, then I would probably leave them alone, because if you consolidate, guess what? That impacts your length of credit, because your old ones are going to go away and you're going to have a new student loan. But one big thing on student loans, and this is a big thing to pay attention to, especially with a lot of millennials coming out of college with a lot of student loan debt, that is what happens to those payments for mortgage qualifications if that student loan is in deferment. That's one of the handouts that Rita sent around. It's a chart that shows by mortgage program exactly how we handle student loan payments if they are in deferment. And in general, we're going to count about 1% of the balance as your monthly payment. So it's slightly different depending upon the mortgage program, but that's basically it. We have to use the assumption that at some point in the reasonable future, you're going to have to start repaying. So if your credit bureau doesn't show a payment, we're going to add one in there. And again, it's different depending upon the mortgage program, and we may pick a different mortgage program to help someone qualify based on how the student loans are calculated, but the payments do count, even if in deferment. Now, the payment history, if it's in deferment, doesn't count. The credit utilization ratio doesn't count, so you don't get credit on your credit scores for student loans that aren't actually being paid, but they do impact your affordability. We talked about credit monitoring, getting your own credit scores. Is Credit Karma accurate? Sure, it's accurate. It's going to give you a good idea of how your credit looks using their credit scoring models. You'll see if you have fair credit, good credit, excellent, etc. It's a great tool, but it's not going to be the same credit scores that we are using or even some other creditors use, depending upon what you're trying to do. Do's and don'ts. One of the attachments that Rita sent around was 5 ways to build healthy credit. Most of it is common sense stuff. Pay your bills on time. Don't max out your credit cards. Keep your balance low, at least a third of your credit limit or less at all times of the month. So if you have a $300 credit limit, keep your balance at $100 or less. Don't apply for just any and every credit card. They offer you 10% off on your purchase by getting a new credit card. Probably don't do that. Unless it's a really big purchase, you really are getting some sort of deal. If you have great credit, doesn't matter. But if you're marginal, you probably don't want to do that. Some of the obvious. Don't let bills go to collection. Don't open new credit when you're about to do something significant. Don't miss payments. Only spend what you can afford. If you can't afford something, don't put it on your credit card and run up your credit card balance if you're working on your credit. And remember, a credit history is exactly that. It's a history. History takes time. To build an excellent credit history, a healthy credit history, it's time. So the more time you have to work on it, the better. We tell folks all the time, it's probably too early. I don't want to buy a house for 6 months. Well, then let's take a look now to make sure you're in good shape. If you're in great shape, we know you're doing the right things. Keep doing what you're doing. If not, you can fix a lot in 6 months, especially if you do some professional credit repair and improvement assistance. So there's a lot of opportunities if we have time. The more time we have, the better. And the more folks are willing to work hard, the more chance we have of getting things fixed up, cleaned up, and ready to go. And red flags, there's nothing huge that we need to cover there. We're going to look for anything suspicious or out of the ordinary. I guess student loan payments could be a red flag. It's not really necessarily related to credit, but it's something we have to pay attention to. Anything that doesn't show a payment that may have a balance due, we're going to have to find what a monthly payment would be. And anything with any deal we know outside of credit, there could be things that pop up, could be things that mess up credit and mess up our approval. Okay, here's some tools, tips, and resources real quick. Like I said, we're on the home stretch here for free home ownership education. Great class, absolutely free. They talk about credit. They go into getting ready for a home purchase, including how to have an excellent credit rating, vhdafreeclass.com. Free annual credit report. Every person is entitled to a copy of their credit report each year from annualcreditreport.com. You can add rent payment history to credit. You can just Google it, but the best one I have found is rentreporters.com. You can add your utilities to credit through Experian using Experian Boost. If you need to add new trade lines, you have somebody with no credit, you can just Google for opening a credit card, but I do have a list of some folks that are pretty good, just folks I've run across over the years that were pretty aggressive at giving credit to just about anyone and everyone. If you have some real significant credit problems or need credit improvement quickly, there are professional credit repair and improvement assistance companies. Again, I've been doing this a long time. Very few of them actually do much of any significance. Most people are not happy and rarely do. They get turned around and end up buying a house. But I have found one in particular, but a couple that actually really do a good job, communicate, get people fixed up and cleaned up and turn them around. I've seen them pull credit scores up 100 points in just a couple months. They can be pretty amazing. Then one other thing, we talked about the credit bureau selling your information. If you or one of your clients wants to stop that, you can go to optoutprescreen.com. That's the official credit reporting website or credit report website, where you can opt out of getting the credit offers for insurance, for credit, etc. It'll cut down on your junk mail and stop them from selling your information. And then lastly, debt stress. Debt is stressful. It can cause a lot of issues for people, especially when things get behind. So we encourage people, use credit smartly. Don't let it hurt your life. If you don't need something, don't buy it. Don't max out your credit cards. Keep an eye on your prize. I want to buy a house. I want to be successful, be a successful homeowner. I don't want to suffer from anxiety and depression and heart attacks and all of the other things that can happen when we are overrun with debt or even behind on debt. So that's what I wanted to cover today. I know it's been a lot of information. This is a great class with a ton of info. So if you don't have any questions, feel free to hop off, or you can always follow up with me. I'm not hard to find. And if anybody wants to hang around and ask for questions, I'll stay as long as anybody has questions. So Rita, any information?
Yes, we do have some questions. If you want to check out your chat box as well. The credit sites try to get you to get a new card and consolidate debt. Is that a good idea? I think you might have answered that, but.
Let's see. Yeah, I don't see the chat box. Oh, wait, here that is. So anyway, you can just read them to me. Okay. Probably not. It depends. A lot of the answers are, it depends. Keeping in mind, length of credit is important. So if you consolidate, you're going to have new credit. But if you have a bunch of maxed out credit cards and you consolidate it into a closed-end loan, yeah, you're going to have some impact from length of credit because you're going to have a new loan, but that's only 10% of your credit score versus that balance versus credit limit. Having maxed out credit cards is going to be 35% of your credit score. So, in that case, yeah, it might make sense to do a consolidation. So you just kind of have to manage one versus the other, to see, really, if it's going to be a big negative removed, then yes, it's probably worth the small negative from having a new account.
Okay, and the second part of that question was, or move debt to accounts with zero balance deals.
You could spread debt out, yes. So they're going to look at overall credit usage, but it can have some positive impact in some of the credit scores. So saying having one account maxed out, having 3 accounts with lower balances, if you have the 3 accounts open. If you're opening 3 new accounts and moving balances around, that's probably not necessarily a good thing.
Okay. Now, if someone is retired, how does that affect them getting a mortgage? And what if they haven't retired yet and want to move into a different home? Should they buy now or wait till they retire?
Well, that won't impact your credit at all. But from a mortgage perspective, we're going to use whatever income you have that is predictable and reliable. So retirement income is just fine. So if you are currently retired, we're just going to look at what your retirement income is. Social Security. Some folks also have disability. You may have a pension. You may have 401k, where we're going to use disbursements, or for employment related assets. Even if you're not taking disbursements, we can use the balance. So say you've saved a lot over the course of your career. You saved $1 million in your 401k. We can basically average it out over the 30 years. So we take your balance divided by 360. We'll use that as a monthly income. So there's a lot of income opportunities. And if you're about to retire, that can be a little bit tricky. We're going to need to know in writing what your retirement date is and what your income will be. So if you're working and I'm retiring May 1st, but I have in writing my pension's going to be $2,000 a month, then we can use that income. And any fixed income like pension, retirement, etc., we just need to know that it's expected to continue at least 3 years or more. So say if you're taking 401k disbursements, we want to see that there's enough money in your 401k to last at least 3 years. Or if you have disability, it's a permanent disability, not like a 3-month type of thing.
Okay. And I think it's just one more question is, what is Y9 status under MOP?
Yeah, actually, I've never seen that. That was just on the sample, the template credit score. I think they just use that as a place setter. I've actually never seen a Y, so I think that was just for their template. That's kind of what they stuck in there. But then when we saw the I's, the R's, the O's, the M's, that's what we would typically see.
Okay. All right. Well, that was the last question, unless someone in the class has another question. Feel free to ask.
And if not, just give me a shout, shoot me an email, shoot me a text. Kevin Onizuk, I'm not hard to find.
All right.
Well, thanks, Rita, and thanks for everybody that attended.
Great class. Y'all have a good day.
Thanks.
Thank you.